Welcome back to Options Trading for Beginners. In our last video, we laid the groundwork by explaining what options are and the difference between call and put options. If you haven't seen that one yet, I highly recommend checking it out first, as it sets the stage for everything we'll cover. Today, we're diving into one of the most crucial concepts in options trading, the option premium. This is the price you pay to buy an option contract. Think of it as the cost of your right to buy or sell an asset. It's the market price of the option, and it's quoted on a per share basis. Since one option contract typically represents 100 shares of the underlying asset, the total cost you pay for one contract is the premium multiplied by 100. For example, if an option has a premium of $2.50, the total cost to buy one contract would be $2.50 times 100, so $250. This $250 is your maximum potential loss if the trade doesn't go your way. But what exactly goes into this premium? It's not just a random number. The theoretical price of an option, and thus its premium, is influenced by several key factors. These include the current stock price, the strike price, the time until expiration, the volatility of the underlying asset, and the risk-free interest rate. While all these factors play a role, some have a more direct and immediate impact on the premium's fluctuations. The current stock price is obviously fundamental, as it's the price of the asset your option gives you the right to buy or sell. However, its direct impact on the premium is often captured by how far it is from the strike price, which we'll discuss as moneyness in a later video. The strike price is the fixed price at which you can exercise your option. It's a defining characteristic of the contract itself, rather than a variable that causes the premium to constantly fluctuate. The risk-free interest rate reflects the return you could get on a risk-free investment over the option's life. While theoretically important for precise pricing models, its impact on option premiums for shorter-term options is generally quite small compared to other factors. For the purpose of this video, we're going to focus on the two most dynamic and impactful factors that significantly influence the premium you pay: time until expiration and implied volatility. Let's start with time until expiration. The amount of time remaining until an option expires is a crucial factor that contributes to its extrinsic value, often called time value. This is because the more time an option has until expiration, the higher its premium will be, all else being equal. Why? Because with more time, there's a greater chance for the underlying stock price to move in a favorable direction, making the option profitable. As an option gets closer to its expiration date, its time value erodes. This erosion of time value is a concept we'll explore in much more detail when we talk about theta, one of the Greeks. The other major factor influencing the option premium is implied volatility. This is the market's expectation how much the underlying stock price will move in the future. It's not about historical volatility, but what the market expects to happen. High implied volatility means the market expects large price swings. This makes options more expensive because there's a higher perceived chance of the option becoming profitable. Low implied volatility means the market expects smaller price swings, making options cheaper. For example, if a company is about to announce earnings, the implied volatility for its options will often spike because there's a high expectation of a significant price move after the announcement. So, to summarize, while several factors contribute to an options premium, the two primary drivers that cause its value to fluctuate most significantly are time until expiration, more time equals a higher premium; implied volatility, higher expected price swings equal a higher premium. This concept of the option premium and the factors that influence it is a cornerstone of options trading. It's the what you pay and why you pay it for the right to control shares with leverage. In our next video, we're going to build on this by diving into strike price, moneyness and expiration dates. These are the specific terms you'll see on every option contract, and understanding them will allow you to precisely choose the right options for your trading strategy. Don't forget to subscribe so you don't miss the rest of the series. Thanks for watching, and I'll see you in the next video.